First way, all out attack. Right, let's go on a bit. We'll do a bit on futures and options this afternoon. I don't want to bore everybody with overly complex explanations of these things, and also a fair few people probably know most of this anyway. But really, for people who aren't massively experienced in the industry, don't have huge knowledge, just a little bit on who you're trading against, what exactly other people are trying to do. Because people are not like us most of the time. In fact, there's very few people in the market that are actually like us in the way that you go about trading. They've got all sorts of other things that they're trying to do with various different derivatives. I won't spend too long on options. Nobody trades options here, really. The only option trades I ever see is people have bought way out of the money options on the hope that something spectacular happens, which generally seems to amount to very little. So it's one of these things that's a nice idea. But options do matter at certain times of the month, and there's trades to be done around there. So you need, at least if nothing else, to look at whatever markets you're trading and find out when the option expiries are for each different market. So that's pretty important. Right, we'll get on to a little bit on futures and options. Futures, the whole point of them is it's a mechanism to hedge stuff. So when I talk about a cash market, that's the underlying asset, the actual thing. So the stock, the bond, the commodity, the currency. Futures are just a promise to deliver whatever it is at a certain point of time in the future. You deliver a standardized amount for the price that you agree now. The idea behind it originally came from commodity markets, grain markets predominantly, whereby you could guarantee now what you're going to get paid for your grain in future. Or as a buyer, you can pay now for what you're going to receive in future. This takes out the risk of good harvests increasing supply, bad harvests increasing demand, so that you know what you're paying. That's the origin of it all. Futures, or what were forwards, then became standardized and exchange traded, so they're then all the same types of thing, which means you can trade them with each other. If it's a forward contract, it's very bespoke. It's an agreement between, say, me and one other person. It's quite hard to get out of that contract or to sell your side of it unless you can find someone who wants the exact matching requirements. That's why futures are developed, because it's standardized. As I'll mention in a bit, futures don't provide a perfect hedge for anything because they are standardized. You are probably not trying to hedge the exact position that you have in the underlying asset. So there's always an element of imperfect hedge, which is what makes them constantly trade and move around. Vital to know, they expire on a monthly or quarterly basis, dependent upon what asset you are trading. Currencies, bonds, and equities all expire quarterly. There are now monthly contracts on things like currencies in particular. So you can trade a November euro-dollar contract. Almost nobody trades it, there's no liquidity. You want to be trading March, June, SEP and DEC. If you're not trading those, forget it, just move away. Commodities, on the other hand, do expire on a monthly basis. Gold's a little bit different and expires sort of bi-monthly. It's got a really weird pattern of expiration in it. You need to know this so that you don't hold your position to expiry and get delivered the stuff. And you can end up with all sorts of different things coming your way. Everyone's heard of a story of it happening. I don't know anybody it's happened to. I don't know anybody who can say that they actually know the person it's happened to. But we've all heard about things like lorry loads of coffee turning up at offices. I don't know if it's ever actually happened, but there is a genuine risk. At least with something like oil, the oil won't turn up here, but you'll get a call saying your oil has been delivered to Cushing in Oklahoma. You now owe us storage and transportation and insurance costs on this. You don't want to do it. Also, you'll probably get fined from your broker as well for doing it. Just don't do it. It's pretty easy to work out because you're looking at your market. I changed my oil today, but if you look at your market and it seems to look very, very thin and there's no one there, it's getting very close to expiry. Just get out of that. That's how we ended up with the negative prices in WTI a few years ago. It was a spectacular day to see. But that was all down to, it was the last day of the month or last day of the contract. People had to get out and, well, you had to sell and there was no one there. So it traded negative. Pretty impressive. Most things are now cash settled, so you don't actually take physical delivery. Yeah, that's always been the case with financial futures, things like stocks and bonds, that you don't actually get delivered. The stocks, for example, if you bought the S&P, you're not going to get delivered 500 stocks in the right weightings of each of them. You will get delivered effectively the cash value and you then pay the cash value. And the difference is what you paid when you bought compared to what it is now. Hopefully it's higher. But on the whole, nobody's actually going to take their contracts to expiry. That produces some opportunities. We've missed, or we've gone past the September expiry, but we will get option expiry, so we'll talk about that when it comes up. Option expiry for equities, incidentally, is the third Friday of the month, so it was last Friday. There will be an opportunity on it in November, and we'll talk through what the trade is. Fair value is a really important thing with futures. I'll explain this very briefly, that effectively fair value is the difference between the cash asset and the futures price. The futures price has to take into account various different things. Let's say if you're buying a commodity, well, you've got to factor in the cost of transporting that commodity to wherever, insuring it and storing it. If you don't own it yet, but you've agreed to buy it in a month's time, you don't have to pay those costs until you get it. So the futures price typically is higher than the cash price, not always, but I won't get into those factors and probably won't explain it massively well. We can hand that over. But the whole idea there is there is a difference between the two. This is what keeps futures and the underlying cash markets in line as well, because there's an opportunity to arbitrage. If the fair value gets wider or gets narrower, one of them's mispriced. So you could then buy one and sell the other, which maintains the pricing difference. So they are directly linked in that sense. I'll give you an example of fair value in a couple of minutes, once we've covered a couple of other different, very similar types of things. So I mentioned cash market, that's the actual individual thing. With cash market, it's not actually leveraged because you are buying the actual assets. You need the money upfront to buy it. You could leverage it yourself in the sense if you borrow the money to buy the asset, then you've leveraged it. But on the face of it, it's unleveraged. So if the value of whatever you bought goes up 1%, you earn 1% on it. Therefore, you need quite a lot of money to actually make a great deal. You want to make 1,000, then you've got to put in 100 grand for a 1% increase. Pretty hard to do, or at least you need a lot of money to start with. Futures are directly linked in the way that I just explained, but they are leveraged. One S&P contract is worth 50 times the index value. You don't have to pay 50 times the index value to own one S&P contract though. So that's where the leverage comes in. You only pay about 2.5 times the index value. So you can see where that leverage then comes in. ETFs operate in a very similar fashion to futures, apart from the fact that they are effectively shares. So you buy into a unit fund, the fund buys the futures. So you're able to get the asset price appreciation or depreciation by buying into an ETF. Again, it's unleveraged, but it does mean that people get the ability to actually trade stuff that you wouldn't normally. You know, it's very hard to trade corn or oil or any of these things without actually trading the asset itself. Nobody wants to be buying oil or corn, and a lot of people don't have the ability to trade futures, and you can't really hold a futures position for that long without a lot of money. So it allows people to capture some of this movement by investing in ETFs. There's big ones on all sorts of different things. You know, SPY is the main one that most people look at. QQQ is the NASDAQ version. You then got GLD, which is gold, government bonds, USO is oil. There's all sorts of different ETFs. What this allows people to do, and it's proliferated passive investing in years gone by or in recent years, whereby you can just buy the ETF. You don't have to then go into any other way of investing. You just, right, I want to buy stocks, buy the SPY, and that will give you the same gain as the SPY index. The other one that gets mixed up with futures is CFDs. Effectively, you could call this an over-the-counter derivative. It is ultimately just a bet on something, because with a CFD, it's not in its own market. It's not an exchange traded product. So if you buy a CFD, you can't sell that to anybody else. You can only sell it back to the person you bought it from, which is never a good thing. It's like buying a car with an agreement that you will only sell it back to the dealer you bought it from. It's not usually going to work out well for you, because the CFD brokers can set the spreads. So you buy, you want to sell, well, you've got to sell down here because that's the only price that you're able to, because they've set the price for you. These don't have to track the underlying asset in the slightest bit. They will to a degree, because there's competition between the CFD brokers. So if you get known as the one that rips everybody off and offers really adverse spreads, well, no one's going to trade with you, but that's the only thing. So in low liquidity times, you can still get these massively widening spreads in them. Generally say stay away from them. The attraction is you don't pay margin a lot of the time. That to me is a little bit of a dangerous one. If you're not paying margin, well, the other side's not paying margin, which therefore means if something goes wrong for them, you're not getting paid anyway. This happened with Alpari, which is a CFD broker on the Swiss National Bank trade, where it turned out that they ended up going bust. And so therefore, even if you made money on the Swiss National Bank trade, you still didn't get paid. That's the problem with them not putting margin up. Theoretically, you don't pay a commission on a trade either, but you pay it via the spread, which is a stealth commission, but nobody notices that. Or people don't if they don't want to. In general, I'd stay away from CFDs personally. The one upside in the UK is they're non-taxable because they are considered gambling. The downside in America of that is, well, they're gambling, so you can't do it. I think these are probably going to get increasingly regulated over time. Ultimately, everything comes back to the cash market. That's the driver of everything, ultimately. And they're linked through various different ways. That's the most tenuous link. The other two, one's the sort of mandate set by the fund, so will, and the other one via arbitrage. If the difference between the two widens, it will then get traded back very, very quickly. You will get situations where this happens, so it's worth pointing out the idea of arbitrage between fair value and cash. This is on the CME website and their explanation of fair value. You can see how long it's been there because the S&P was at 1100 when they put it up and the interest rates were 5.7%. So this was probably around about early 2007, late 2006. Last time I can think that you had that type of layout of interest and price. The way it works for, say, equities is that the fair value price, in this instance being higher, has to factor in a few different things. If you're buying futures and not the individual stocks, you're missing out on dividend income. You're also missing out on interest because you could put your money in the bank and just earn 5.7%. So you're missing interest, you're missing dividend income for however many days are left on that contract. Therefore, the S&P futures price needs to factor that in. It's a higher price to account for what you're missing out on, opportunity cost, if you will. So in this instance, you've got an 11 tick difference. If you get a situation where the futures are trading 15 ticks higher, well, there's something mismatched there. Theoretically, what you should do is sell the futures, buy the cash, and wait for them to match up. In practice, what most people will do is sell the futures and assume that they will match back to the cash rather than the other way around. It's not something you do on a day-to-day basis. It's not something that's feasible on a very short-term basis. That kind of stuff is wrapped up by hedge funds like Renaissance Capital, who are doing this kind of thing over and over and over and over in multiple different markets. It doesn't really apply on a very short-term basis. Where it does apply is on the very few occasions, and I say few, it does happen, not super frequently, but it does, where you will get the futures exchange goes down for whatever reason. Fortunately, a little while ago, on this day of the course, it happened. It was like, here's a perfect example, guys, look what's going to happen. And basically what you ended up with was the Eurex went down. They shut the exchange for whatever reason and said, we're going to reopen at 1:30. What you need to do in that situation is work out the fair value. You don't need to go through the maths of it. That's tedious and you'll probably get it wrong somewhere along the way. Simple way to look at it, look at where the cash was at the close, look at where the futures were trading at the same time and work out the difference between the two. Once you've done that, you know what the fair value is. In this instance, 37 ticks. Cash was higher than futures at the time. Reason being, Europe had got negative interest rates. So you're actually not missing out on anything by buying futures. You're actually gaining the negative interest rate, which is why you had a difference in price. But if you know there's a difference of 37, when you get to the point where they reopen, so Eurex shuts, it shut about 8:45 in the morning, and they say, we're going to reopen it at 1 o'clock. What you can do then is watch the cash price and take 37 away from it. That's where the futures should reopen. If it doesn't open there, something's wrong. The futures are the ones that were shut, so theoretically they're the ones that are going to go back. So the trade was then very, very simple, that with it opening at 28.82, that only gave you a 30 tick difference. This needs to go down basically. So the trade was, as soon as it reopens, sell it straight on the open and go for a 7 tick winner. Realistically, you go for a 6 tick winner to make sure you get out, because to correct 7, it might trade 7 and not get you out. You better have to go for 6, you're out. It's about as close as you ever get to a kind of free money trade. Yeah, there's only one thing that should happen in this situation. It can go wrong if the cash equates to the futures, but there's no logical reason that should happen. The cash is where it is and it's trading at the moment. If the futures open higher, they're the ones that have been forced to open at a high price for whatever reason it is. So that becomes the trade. Like I say, you won't see it often, but it's the kind of thing that's just worth knowing, because if it does happen, you've got a quick trade on it. Eurex seems more susceptible to going down than CME as well, just incidentally. Not a reason to trade Eurex, but something to be aware of. Right, who are you trading against? Because this is not other people like us most of the time. There's very few other people like us. There are very few other retail traders out there as well, at least very few retail traders who have any kind of serious impact and are not people punting around on CFDs. I try and view these in two different aspects. There's financial futures, bonds and stocks, and then there's what I kind of call real world futures, commodities and currencies. You need commodities to make stuff, you need currencies to buy the commodities to make the stuff. So the people using these two in particular are essentially end users a lot of the time. People who actually want the oil, want the gold, want the copper, whatever it is, to produce something. Or they're the people who are mining the stuff and or growing it if you're looking at grains and stuff like that. So you've got a large number of original participants, if you will, producers, consumers in these markets. Likewise with currencies, if you are, let's say, a UK company, or to use this example better actually, a European company, and you're earning dollars, well, you know that you're going to earn X amount of dollars over the next year. Rather than just waiting for those dollars to come in and exchanging them back to euros, you start to look for a point where you could hedge that, i.e. sell your dollars now so that you know exactly what you're getting in future. You know that you've sold your million worth of dollars for X amount. Doesn't matter what happens to the dollar then. If the dollar weakens over that period of time, that's fine, because you've already sold all your dollars for a higher price. You effectively then earn the dollars that you've agreed to sell on your futures contract. Whether you run it to expiration or not doesn't matter, but you're effectively matching off your future earnings against your current price. So you have a lot of people who are genuinely using these to actually hedge real world risks. To give a very, very brief explanation of what happens, which again goes against what most people kind of short-term traders think. If you're a producer, you're naturally long. You've already got the stuff. So you've already got the upside increase in value. Your risk is that the prices start to fall. So if you're producing, let's say, wheat, as prices start to rise, these participants are not sitting there going, oh, price is going up, let's buy some more because I'm going to try and get the next 2% move up. Prices rising are better prices to sell at. So you get more and more sellers coming into the market, at least larger time frame actual producers. Conversely, as prices rise, consumers don't really want to be buying up there. So you start to run out of buyers because, well, who wants to pay these prices? At these prices, the consumer is not making any money. So they need the price to drop. If you're making bread, you want the price down below the red line, in which point you can actually make some profit. So as prices fall, the consumers will then start to buy to effectively lock in their prices. They're not super price sensitive in the sense that, like us, we would react on a day-to-day basis to price. For their perspective, if prices fall, they're getting better and better average price for the stuff that they're buying. This then means as prices drop, you end up with loads of buyers all wanting to buy and very few people to sell to them. As you end up with less sellers, well, buyers have to move their prices up, otherwise no one will come and sell to them. And that's how you end up with this sort of rotation in markets. A market essentially tries to find some degree of balance. You could end up with a bit of balance in the middle. What you have to remember from our perspective is there are not hundreds and hundreds of producers and hundreds of consumers. So you've got these few people with a lot of business to do that don't necessarily meet in the middle. That would be perfect for them, but they won't. Shorter time frame people are there effectively to take the risk off them. A producer might want to sell up here, they won't find a consumer, but they might find a few short-term traders who are going to sell up there because they're trying to capture this move down here. So if you want to see a nice social benefit to what you're doing, you're providing liquidity. You're getting the economy running smoothly. Otherwise, you just have loads of producers saying, we're selling it up here, consumers buying it down here, and nothing will happen in between. Productivity will fall apart. So you're oiling the cogs of finance, if you don't like that. But essentially, that's what goes on a day-to-day basis, on a week-to-week, month-to-month type of basis. So don't always assume that everyone you're trading with is like you. Don't ever get caught into the trap of, why in the world would somebody be selling it here? Well, probably because they've got some hedging to do and they need to sell it there for whatever reason. Unlike whatever your view is of what are you doing selling it there, it should be going up. Someone's got some business to do. Before we get on to rate expectations, the other part of why you get sort of quicker moves as well is Once prices start to drop, as a consumer, you're going to look at that and go, wonderful, prices are dropping. I'm not hedging now, I'm going to wait for prices to keep dropping. At the same time, producers may need to get their business done quicker. So their motivation to trade changes. They're not now just selling into ever raising prices, they've now got to do something. And they're trying to sell when there's not that many people trying to buy, which means that you get this much quicker movement as people rush to sell and sell and sell. Could be what we end up with oil today, albeit it looks like it's going to open very in the middle, well, it has opened very in the middle of nowhere and done not a great deal of anything, which is unfortunate. It's currently trading at 70, which is bang in the middle of that range. Not ideal. Well, not ideal for us. What futures will also give you is certain assets will give you a whole curve. So we'll talk about this more when we get into week 4 or week 3 as it will be this time, and central banks' interest rate expectations. So if you want to trade interest rate products, you can look at ZQ, which is Fed Fund Futures. This will show you, and you can work out what the expectation is of a rate cut at any meeting going forward based on the price. You line them all up together and that shows you the expectation of future interest rate changes. This is really, really valuable when you're trying to work out, is the market pricing in a rate cut or not? So is it expected or not? This is where we were in March this year. So effectively for 6 months from March, zero expectation of a rate cut from the Fed, and then a very limited expectation of cuts for the rest of the year. This is when they were pricing in one rate cut. You go to August, post payrolls, that 6 months has now gone straight down. And then you're looking at more and more and more as time goes by. So this then shows how the market perception has changed. It shows what is now expected from the Fed. It also gives you a good sense of where the best opportunities are going to be. It's going to be a far bigger surprise if the Fed didn't cut rates than if they did in line with expectations. So you're always looking for that kind of where's the biggest potential move. This will have softened recently, and it will probably be looking a bit more like that, and then somewhere along those lines. I wouldn't worry on short-term interest rates, anything beyond really 2 years. Yeah, this is just pure speculation, but there are rate markets going that far out. But where interest rates are going to be in 30 years, nobody's got any idea. You know, you look at where rates were 30 years ago, they're very, very different to where they are now. And I don't think anybody would have called that back then. People were quite happy to pay 10, 15% on their mortgage. Now people would be shocked at that idea and, well, wouldn't be able to afford it. So very useful. We'll come on to that a little bit more detail as we go further on, particularly when we get to the interest rate decision. Best website going for this type of thing is CME FedWatch. It's fantastic. It gives you the pricing of future US interest rates for whatever meeting you want to go to, and it will show you the probabilities or market's current perceived probability of a change at any of those future meetings. Really useful. They've also now got an ESTR watch as well, which gives you the European version. So fantastic website, well worth a look. Right. The other side of futures is the financial futures. Nobody needs these in a sense. You don't need to own stocks. It's not going to enrich your life in any way. You won't starve if you don't own them. Your car will still work if you don't own stocks, same with bonds. But people own them. It's an alternative to putting your money in the bank. You could buy stocks. You could buy government bonds, corporate bonds, all sorts of different things. So what is generally going on here is people hedging portfolio positions broadly. You'll also get a lot of hedging of positions that banks take in order to service clients. So for example, an investment bank will buy government bonds. Reason being, if a client comes along and says, I want to buy $1 million worth of German bunds, they've got them. But what they don't want is the outright risk of owning those. If they own them and the price of bunds drops out of the sky, they're now losing money on it. So they'll buy them and then sell futures to hedge that. So they're just matching off the risks. You'll also get all sorts of far more complex derivative transactions that then are hedged in different parts in these. I won't go into too much detail on that. If you want to understand that more, there's a fantastic book called Traders, Guns and Money. It's brilliant at explaining the intricacies of how complex structured products then get hedged into, I guess, less technically wild markets like futures and options. But a whole real simple way of looking at this is you've got a portfolio of stocks. Obviously, it's not going to perfectly match the S&P, but you perceive there to be some risk out there, let's say COVID. Rather than selling all of your stocks, you could sell a futures contract. Therefore, you keep all the stocks you've got. If price drops, you will make money on the futures, which will cover the effective loss on the stocks. If prices rise, well, the value of your portfolio will go up, but you're going to lose on the futures. You can get out of the futures, take your loss there, and you've effectively made it up. The difference being there's an actual financial loss that you've got to be able to wear to actually do that. To give an example, when the S&P was trading just shy of 5,000, you could hedge a $250,000 portfolio with one contract. 50 times 5,000 being $250,000. So if you think there's some risk out there, you sell one S&P contract, whatever the value of your portfolio changes should theoretically be matched off. They're never going to be a perfect hedge unless you've got the exact makeup of all 500 companies in the S&P in your portfolio in the right weightings. One futures contract will never match it perfectly. You might be slightly overhedged, you might be slightly underhedged, but it will at least serve as some degree of a hedge for you. Same principle with bonds, that if you perceive interest rates to go changing massively, you might want to sell treasury futures to hedge your portfolio of bonds. So that's where the sort of financial aspect's going to come in, people using these to hedge. Yes, you will also get some funds that will just outright speculate with futures. The reason for doing that is, well, it's less cash outlay. You don't have to front so much money if you're going to speculate on futures, because you buy one contract, which will cost you about $13,000 up front, and you've effectively got a $250,000 risk now. Useful until prices drop against you or rally, depending upon whichever way you've gone, because your margin gets wiped out. But it provides a effectively more efficient way to speculate. The other people in these markets, people like us, people are just purely speculating on price changes. And that's what everybody here is doing on a day-to-day basis. So you're ultimately always against similar type of people. It's just trying to understand what they're doing or why they would be doing any of these types of things. There's a little bit less of a direct association between your what you call larger participants in, say, commodities and currencies to futures, not futures, stocks and bonds, because there's less of a sort of direct necessity to have any of these types of things. No one earns bonds or earns stock, within reason. So there's less of a sort of direct impact in that sense. No one's got to hedge future gains in stock because, well, they don't have them. As I said, they're not a perfect hedge. There's a really good podcast if you want to go and listen to one about this. It's on a podcast called The Knowledge Project. I believe it is number 99 or 100 or 101. So around about that number. And it was with Bill Ackman, who owns Pershing Square, which is a hedge fund. What he's talking about is how do they hedge their enormous stock portfolio? Because I think they said they got about 3 billion in stock portfolio. How do you hedge that? Because if you've looked at COVID and gone, this is bad, I don't want to own stocks. If you try and sell $3 billion worth of stock, you're going to crash your market. Bearing in mind that some of those are going to be large positions in individual stocks. So if you try and sell that, you're in trouble. But he also talked then about the whole idea that even if you try and sell futures, you've still got to sell an enormous number of futures to cover that type of risk, which is going to drive the futures market down. The other risk, of course, is let's say you put your hedge on here. This was that I checked the dates out that he talked about. That was when they put the hedge on. If you do it futures and that's it, and it goes back up, you're now in a futures position that you're going to really struggle to get out of because of the size of it in a market that's now rallying. So not only have you got a hedge that's imperfect, you've now got a hedge that's going against you, wiping out your stocks loss. And until your portfolio gets back up here, you're now in a loss on both sides. He talked about doing the trade and they basically put the hedge on here, got out here, which also illustrates sort of larger participants' approach. They're out here, they need liquidity. So what they start doing is they're buying from here all the way down here. And they're just buying to get out of their short position, but also to turn it over and buy more. So they've then effectively just bought the bottom of the market. Probably contributed partly to the low. The bigger contributor was the Fed doing unlimited QE, and then everything turns. It actually goes into much more detail that they didn't do the hedge with futures because it was effectively too difficult to do. It was too illiquid. They'd have to sell too much. I'm not going to go and explain, you don't need to go into too much detail, but he did the hedge via high yield CDSs. So CDSs on high yield debt, effectively corporate debt of not massively creditworthy companies. So buying insurance against those companies. That was how they did it because they could do it in much more size. And whilst they did it with more size, they were not having to hedge quite as much to get the exposure that would match the downside risk on their stock portfolio. Again, rather more complex than we need to go into here. But suffice to say, not the greatest hedging tool, which does explain why you can then get overextensions in markets, as people have hedged something that they now don't need to hedge and have to get out of those positions. People rush to hedge something that they end up over hedging or going too far in terms of the price they pay to hedge something. Right, I mentioned leverage and margin. The way futures work is you don't have to actually front all the money. If you want to buy one oil futures contract, one oil contract is 1,000 barrels. You don't need $70,000. As we just looked at in here, you need about $5,000. So what this does is it gives you far more exposure. Excuse me. Generally, you will have to pay an initial margin of between 5 and 10% of the value of that contract to be in that trade. You then have a maintenance margin. The maintenance is the amount that you need to keep your margin above. So let's say you paid 5,000 in margin. If your trade goes $1,500 offside, you've then got to front 1,500 to get your margin back up to stay in the trade. Otherwise, you'll have to get out of the trade. You lose that money and that goes to whoever is on the other side of the trade. So that's the way that these types of things work. It means that you get exposure to much more risk, much more upside profit without too much upfront cost. Generally, you're looking at about 20 times leverage. So whatever money you put up, you effectively got 20x that in terms of risk. Using an example there, that was a gold one. When gold was traded significantly lower, and I thought, well, that's probably a good level to go for. But gold at the time, you're paying $8,250 in margin. It's $100 a contract. So, it's 100 troy ounces in a contract. So you're paying $1,870 per ounce. So that makes it $187,000 is the value of the contract. Divide it by the margin, gives you your leverage. About, in this instance, 22.6%. So that's how many multiples you've got. It means that it's far easier to make money. It's also far, far easier to lose money. You don't have to see gold go too far against you to lose all of that. 825 ticks would wipe out your entire margin. Gold, even at the time at those prices, could still comfortably do 400 ticks in a day. So you could effectively lose 50% in one trade. You could also make 50% in a trade. This is why I don't like people talking percentage. I made 20% today. Yeah, but you're massively leveraged up on a trade. Yes, it's possible. It's the same when people talk about their percentage gains on a year. At the start of your career, you've got, let's say, a $10,000 trading account. I'd expect people to make 100% a year. If you've got a 2 million trading account, making 100% a year every year becomes quite tricky to be able to continually grow in that pace. So percentage changes on accounts, I don't think make a great deal. The other thing that you need to know, which is probably the main thing that everyone focuses on, is your tick value. So the tick value is the notional value of the contract divided by the increment in which it trades. So if you take something like oil, oil trades in dollars and cents, and it's 1,000 barrels of oil. So a 1 cent change on 1,000 barrels is $10. 1 cent times 1,000. Stocks are set by the exchange. So a stock index, S&P, for example, trades at 50 times the index value. If you look at micro S&Ps, they trade at 5 times the index value. So 1 point on the S&P micros is $5. 1 point on the minis, as they're called, is 50. There used to be a big S&P, hence why it's called an E-mini now. The big S&P used to be $200 a tick, which you can understand why they've got rid of that. $200 a tick now in the S&P is a big move, or it's a big tick value. Personally, I think they need to change the DAX very soon. It's too big, and the mini is too small. It needs to just go in the middle, but they won't do it. Foreign exchange, you have a basket value. So if you're, say, trading cable, so sterling against dollar, the contract value is $62,500. So your tick value is then $6.25 because it's done in increments of dollar. Euro dollar is 125,000. So it's a bigger contract to euro dollar versus cable. And bonds, you have a face value of whatever it is for different bonds. So you need to look at which ones. Most of them trade around about 100,000. It's the face value of the contract. Unfortunately, with T-notes, they still trade in imperial. So rather than say bunds, which trade in decimal, so you trade 100 ticks to move a point, so 135 to 136 has 100 tick increments in between, so it's $10 a tick. T-notes don't. So T-notes then have 32, and then they also trade in halves, so you actually get 64ths. So makes your life a little bit tricky. If you divide 1,000 by 64, it's $15.625 is your tick value in T-notes. And then that goes down, and some of them trade in quarters and eighths, so you end up with a tick value being $7.82.5, which is always nice to work out. Really hard to work your P&L out. Probably not that bad actually, in a sense that then you don't focus on your P&L because you can't work it out in your head anyway. No one's that quick, so quite useful. You can find all of this in contract specs. If you go on the CME website, I think I had it up a minute ago. Oh, I've turned it off now. Go on CME website, and in fact I might just bring it up.
I just have a question, sorry. So, do you mean to say that if it was to move from 135 to 136 in T-notes, it's 64? So it's not 1,100?
Yeah, there would be 64 price increments. Yeah, so it would trade in 30 seconds, and then you'd have a half of a 30 seconds. So it'll show you a T-note ladder. That's a T-note. So you're currently trading 111.27.5. It's 112 once you go above 111.31.5. Because that's up to 32, yeah. So that's the way it trades. Ugly. Why they haven't changed it, I don't know. I blame America. I think a lot of it is stuff that's on CBOT, because T-notes trade on CBOT, which is Chicago Board of Trade. A lot of the stuff they have is agricultural there, and a lot of the agricultural still trade in Imperial. So they don't seem keen to change. I guess everyone knows it now, so that's the way it goes. CME contract specs. There you go. So you go on CME website, look up oil, you've got all your contract specs there. So it will then tell you trading hours, tick value, minimum price increment. In this instance, it is deliverable. So if you hold it to expiration, you will get delivered your oil, not directly to you, as I said. When it expires, you've then also got margins up here, all sorts of stuff. CME website is really good. It's really easy to use. Everything is where you expect it to be. Eurex website is a nightmare. It's really, really opaque and really confusing. It's not nice, but CME is great. So it gives you all the information you could ever want. Ultimately, at least from our perspective, margin's not something you ever worry about. If you're, say, backed here, they pay the margin. So you have the way it would work, a prop firm is you effectively have an agreement. You're allowed to trade 10 S&Ps. Who pays the margin? You don't worry about. We pay the margin on that, but you're allowed up to 10. So you're capped by the amount that's agreed. Whereas, like, let's say you go and put your money at a broker like, say, AMP. If you've got 50 grand in your account, you could trade any number of different contracts as long as you don't use all your margin. Whereas, with most prop firms, there will be an agreement. You can trade this and this and this and this. You can't trade other stuff, but you'll be able to trade a certain number of contracts in each, and then we will pay the margin on it. But it's all there on the contract specs if you want to read it. I would also send all of this over for you. I've got a whole PDF that has got all the markets that you'd want to trade, including the codes for them as well. That's something you need to know, because if you want to go and get a ladder up of Japanese yen, you need to know what the code is, 6J in this instance. All of the other different commodities, equities, currencies, etc., etc., etc. So I'll send all of that over to you. I've also got on there, and these may need to be adjusted actually. No, I think broadly they're all correct. The number of contracts that you'll be able to trade. The reason that we've done it like this is to make it a little bit more realistic. There's no point in people trading on a sim during the course going, oh, look at that, I've traded 100 S&Ps and I've made 20 grand a day. And then they go live and you're like, oh, I'm trading 3 S&Ps and I can't make 20 grand a day. If you're trading 100 S&Ps on a regular basis, I'd expect you're able to make more than 20 grand in a day. If you're trading 3 S&Ps, then I wouldn't expect you to be able to do that. You still make 1,500 or so, reasonably easily. But that's, all of the different markets out there. There are a number of other bits and pieces. I've not listed, say, Bitcoin futures. You can trade Bitcoin futures if you want. It's a pretty wild place to be. But I think Bitcoin futures will become more and more tradable over time. The more they get accepted as a product to trade, even if nobody ever believes that Bitcoin is a thing, the more people that use the futures, the more tradable it will become, the more people will then start to trade it, and it will become an asset in whatever it is. Personally, I have a very dim view of it on the basis that I've never met anybody, I've never met a consistent view as to what they're for. People have got all sorts of different views on, they're anti-establishment, it's a hedge on inflation, it's a hedge on risk, it's equivalent to a currency, it's equivalent to stocks, it's equivalent to gold. No one's ever given a straight answer. You know what you want oil for, you know what you want dollars for, etc. Crypto, no one seems to know. So it still trades, it still does something, but it's pretty unclear what it is. But it may just continue to be that. But there you go, I'll send all of that. I will also send you this, which gives you the hours that you can trade. All markets, all futures at least trade almost 24/7 now. They will all have a break at some point where they settle all the day's contracts up. So margin calls will happen, etc., etc. I've got the cash sessions there as well. So this is when the underlying market opens. You will really notice this, particularly in equities and in oil more so than any of the others. And when the cash opens, the volumes jump massively during those periods of time. So that is generally, if you're going to trade a specific period of the day, you trade the cash hours, not the rest of it, just because the increased volume, it becomes a little bit cleaner to trade during those periods of time. So all your cash hours, I've got all the month codes as well. At the moment, everything is on December. You will, before the end of the course, see oil switch to January. You'll probably see gold switch as well. Gold will probably jump to Feb. Gold doesn't seem to go month by month. It jumps. I don't know why precisely. If anyone does know, feel free to tell me. I found out only last year why the codes are as they are and not the way you would think of them more obviously. Apparently it's so that they cannot be easily confused for numbers. So when you write a ticket, this comes from back trading in the pits, you couldn't accidentally write a number or write a letter that looks like a number. I contend that with Z. Looks a lot like a 2. But outside of that, apparently the rest of them don't look like numbers, which makes a fair bit of sense. So that's why they're used in that way. Just makes it hard to remember. But they're all there. The main ones you need to know is H, M, U, and Z, because that's where most things trade. Right. Few reasons to trade futures, which really kind of comes back to what I was saying about CFDs and where I think CFDs is going to get regulated out at some point in time. There's a few different reasons. What I've done here is I put a DAX ladder next to a CFD platform. What a CFD platform doesn't give you is a ladder. So if you don't have a ladder, you can't see who's waiting to sell or who's waiting to buy. I'll explain ladders in more detail tomorrow for those who've not seen them before. So all you see on a CFD platform is a price you can buy at and a price you can sell at. Now these prices are different to what you're actually trading, because what you've got here is you can buy at 56.5, which is here, and you can sell at 50.5, which is here. Current price is 53.54. So actually, if you want to buy, you can buy at 54 in the real market, and you can sell at 53. So what they're doing is effectively widening the spread. The way that they make their money is when you say, okay, I'm going to buy, you buy up here, they know that they can hedge that straight out, because when you buy, they're effectively short, but they're short 3 ticks above where the market's currently trading. So if you buy the equivalent of one contract, they could instantly buy that contract back and they've made 3 ticks. Nice and easy for them. The other thing that you end up with is, well, there's a few different aspects. That's what's actually happening. CFD is whatever they say is happening, so they can quote you the prices. If they don't like the look of it, they can go, oh, actually it's 66 rather than 56. So now if you want to buy, you're buying up here. You're miles away from market. They can see what's actually going on here. So you're kind of trading with very asymmetric information. The person you're trading against can see what's really happening and you can't. The no commission idea is somewhat shady, because yes, you pay no commission, but you've just paid 3 ticks higher. 3 ticks higher on the DAX is 75 euros. And if you pay 3 ticks the other way to get out, that's another 75 euros. So you paid 150 euros commission rather than €1.80 if you trade in futures. Yes, you don't have to pay any margin, but also the broker doesn't pay you any margin. So what I was saying about them going bust, if the broker goes bust, there's nothing coming back to you. The whole point of margin is, if I put a trade on, I pay margin. Whoever I trade against has already paid margin as well. So I know that whatever happens, I'm always going to get paid, and so does everybody else. So there's, it's completely transparent in that sense. The other thing that people underestimate is the impact you have. Yes, you may only be trading a 1 lot or a 2 lot, 5 lot. So you can't drive the market with that, but you are contributing to the buying. If there's only 3 lots left on the bid and you buy 2 of them, there's now only 1 lot left. The price will have to trade up. And if other people are doing the same, you are adding to it. Yes, it's reasonably insignificant, but it's like voting. Your vote individually doesn't matter. But if you don't do it, it reduces the number of people that vote in a certain way. So you do actually have a degree of impact on the market. If If you're trading a spread bet, you don't. You can buy as much as you want, and if the spread bet company can see that they can hedge that, they can just hedge it out and it means nothing. Also, you can't look at the actual market and see what's going on. For all you know, you think, oh, I'll buy this here, and then somebody sitting there with 300 lots on the offer, it's probably not going up, but you can't see that. So you then buy at 56, and the broker on the other side goes, yeah, you can buy as much as you want, because we'll just buy it into this 300 lot. So there you go, a few reasons you want to trade futures. At the end of the day, futures, you're trading against other people who are trading for their own interests, whereas with almost everything else, you're trading against a broker whose interest is not to screw you over, I don't think, entirely. But at the end of the day, it's in their interest to not offer you the greatest of prices, because they make their money by hedging against you. Whereas, in
many ways, that broker model with CFD is like the old broking model in pre-electronic days, right? Where you would buy whatever price the broker sat in front of the floor traders, right? And you had no visibility or access to those prices. They set the prices artificially to whatever they wanted to sell you to as a client, unless you're big enough to. Yeah,
so it's the same as even now if you go and buy your travel money from Marks and Spencer's, they're quoting you a spread which is wildly off the actual true price. But what else are you going to do? Unless you know somebody who's got some dollars and is willing to give you them for the genuine price, that's what you pay. So it's unfortunate. I think it's such a scam, travel money, but I don't really know what you can do about it. Should set up some kind of exchange. There's a business in there, but it's not for me to do.
Say 2% of the national business of currency exchange by offering small
tiny spread on it. Yeah, there's got to be a business in that. Yeah, I'll worry about it. Yeah, there we go. But there we go. So something to do in the future. Right, options. Like I say, nobody really trades options, but you need to understand roughly what goes on with options, what options do, how they're used. Options work different to futures in the sense that you pay something up front. With futures, you don't, apart from your margin. So the futures, you get back whatever you get back. If you buy and the price goes up, you get that. With options, if you are a buyer of an option, what you're doing is you're paying upfront for the right to do something in future. So you pay upfront now and say, right, if the price is X in future, I can now buy whatever it is, S&Ps at 6,000, or I can sell them at 5,800, whatever the price is. The person on the other side of that is going to agree to sell you them. So if you buy, let's say, what you would call a call option, if you buy an S&P 6,000 December call option, this means you have an expiration in December, your strike price is 6,000. If the price is trading 6,100 in December, the person who sold you the option, if you ask for it, has to deliver you the S&Ps at 6,000, not 6,100. So they've got an unlimited risk. You paid up front for that option, so you've lost some money to start with. Assuming the price has gone high enough, you will make that money back and more. So that's the way that an option works. Call options give you the right to buy something. Put options give you the right to sell something. Now you're going to find it very hard to buy a call option on the S&P at 5,000. No one's going to write you that because the price is where it is now. They could, but they'll write you it with the price difference included in it. So you're not going to get anything out of that. Likewise with put options. What we're interested in is American versus European options. This is not geographical, it's a type of option. The difference is American options can be exercised at any time. Europeans can't. So if anything's a European style option, it can only get exercised at the expiration. This is where the interest is. Because if you've got, let's say, a load of people who bought 6,000 S&P calls and the price is trading 6,100 at expiration, you know, or you can at least surmise that there are a lot of people who are now going to be long 6,000, price is trading 6,100. What are they going to do? They're all going to sell. So you can have an expectation of the way the market's going to move. So you can end up with quite clear order flow moves around option expiries. So American options not overly interested in. Most options are European. So we've got an advantage there. Even the things on US products are not often American style options, they're predominantly European style options, because it gives clarity to the people writing the options and buying the options. They're easier to price if they're European compared to American. So they're the ones that we're interested in. There's all manner, if you go and Google it, option pricing charts, there's all sorts of different things out there. These are just straightforward, simple ones, which shows you the payoff between somebody buying a call option and someone selling a call option versus somebody selling a put option and buying a put option. The way to look at this is price change, not time change. and then this is profit. So to give a real simple example, if you buy a call option, you're out in this instance $6 to start with, and the strike price is 20.50. Once the price goes above that, if you get to 20.56, you're now flat because you've got to cover the value of the option and then you'll make money on top. Whatever the price goes to after that is profit for you. So you, when it expires, can go, yep, give me them at 20.50 and the price now trading 20.95. You've made 45 ticks minus the 6 that you paid. The person writing the option gets paid 6 up front, and as long as the price doesn't go above 20.50, they're all good because you're not going to exercise it, they bank their 6. So they can collect premium by doing that. They're then at an unlimited loss if the price goes over it. This is where it all went wrong for Nick Leeson, because he tried to sell options on Nikkei futures, collect the premium on his put options that he was selling, and then there was a massive earthquake and the Nikkei fell through the floor. All of his put options then went into the money and he got unlimited downside risk, and that effectively bankrupted the bank. Not ideal. So ultimately, from our perspective, you don't really want to be selling options. You're putting yourself at a huge risk. There are trades out there where you can trade what's called a straddle, where you sell puts and calls, and as long as the price doesn't move outside of a range, you'll make money on the premium both sides. There's all sorts of different option trades like that. Bit complex for what we're trying to do. But what is important to understand about this is the people who have bought the options or sold the options can impact the expiration price with futures. So let's say you sold this call option and prices are going up. You know that it's expiration. As a way of banking your premium, what you could do is try and sell futures, to prevent the price going above 20.50. So you're only going to have to pay out if the price goes above that. So you sell futures, cap the price, hold the market down until expiration. Everyone who bought the calls then goes, okay, I won't exercise them. You bank all of your premium and then you let it go. You're going to have to get out. You'll probably take a loss on your futures, but as long as the loss on the futures is not as big as the amount you made selling the options, your quid's in. Alternatively, if you know that you're going to end up having to pay out on these options, you could buy the futures so that when you have to pay out, when someone says, give me the futures for 20.50, well, you bought them all at 20.40, so you can hand them over. You still got your premium and you made 10 ticks on your futures. Yes, you haven't made 50 ticks on them, but you at least saved yourself getting absolutely crushed. So there is an impact there when it gets towards expiry as to what people try and do to drive the price towards or away from different strike prices. Likewise, if you bought loads and loads and loads of options and they're in the money, you exercise them and you sell. What will realistically happen is people will start to sell beforehand to hedge that position, and knowing that they're going to be able to exercise a large number of options. So that they're not suddenly in a position trying to sell, they're gradually selling knowing that they're effectively going short as the market goes up, knowing that they're actually then suddenly going to get given their out all the way down here. So go for it.
So is there any hedge then? Because options, some of the options are exchange traded as opposed to over the counter. So for the exchange traded options, is there an edge in understanding how many options are at what strike price in relation to your proximity to bet at the close of Oxford's expiry to know where, have a theory about what will actually pushed in what direction by what body is sitting in different strike prices? I
think there can be, You've got to watch the open interest of puts and calls at different strike prices to understand that, yes, maybe if you've seen a huge increase in the number of calls for a certain strike, there may be a drive towards that or equally a drive away. So I don't think it necessarily can tell you which direction we're going to go into the expiry, because you don't know who's got to hedge or not. You also don't know what people have already hedged, But what it can help you with, if you know there's enormous open interest at a certain strike price and you're near it, it's probably going to bring about a fair bit of action on the expiration as people try and push it one way or another.
Couldn't you also, for example, if you know that there is a major news event or something coming up, and let's say the price is at 5 right now, you could buy, you could buy put options at a much higher price in prediction for price to go to that area and then reverse, right?
Yep, I get what you mean.
Sorry, am I saying it correct?
I know what you mean though. You could buy them now in the expectation of
it would be much cheaper.
Yeah.
Because the price hasn't reached there yet.
Yes, the thing that will cancel that out is part of the option price will factor in volatility. I'm not a big one on options, but there's lots of factors that go into option pricing, one of them being volatility. So the proximity to data will increase the volatility or the implied volatility in the options, which will raise the price. So even though, yes, theoretically, yes, it will get priced out by the volatility or the implied volatility in the option, which is, I can't remember what it is. It's not gamma. Yeah, it is. I think it's gamma. Yeah, so there's whole complexities around all of that side of things. There is a good website or Twitter account that's got a lot of traction recently called Spot Gamma, which gives you all of the very well traded option strike prices. They go through watching all of the options and the changes in price. So they give you different, what they call option walls, different points where effectively there is a large amount of open interest, long or short of certain types of options. That's really useful. At least if nothing else, you're just providing you some levels to kind of try and target or move towards if you start to get some flow on an option expiry. Worth a look, I'd say. Just to give a very, very simplified example of this, obviously this is a wildly volatile market in the example that I've given. But just to try and explain where the pricing of options will then change. So if you take a call option with a $100 strike price, as long as the market's trading above the black line, it's what you call in the money. You bought it, it's going to pay you out better than the strike price. When it falls below the black line, it's out of the money. Things that are going to affect the price of the option are going to be the proximity to expiration. The further away from expiration it is, the more time it's got to get above the strike price. So that will then have an impact in raising the price of the option. The distance from the strike price will also have an impact in the sense that if you're far, far below the strike, then the option is going to get cheaper because you've only got a certain amount of time, but you've got a long distance to go. Volatility will also affect that. If you've got very low volatility and the price is trading at 50, you're going to end up with a very low strike price because, well, there's not enough volatility to suddenly get you up there. So the prices will then fluctuate depending upon where you are. So even though, for example, let's say you're here and let's say the price is 70, you're much closer to the strike, but you're very close to expiration. The price may not be any different to over here because the likelihood of reaching it in that amount of time isn't that probable, at least with the level of volatility you have at the time. If volatility's gone up, then this will get way more expensive because the person writing the option runs a greater risk that it will, via the volatility, get over that price. The thing that we're predominantly interested in is the day of the expiration in particular, and you will generally get quite a directional move. And when I say the day of the expiration, I'm predominantly talking the 5 minutes before, 10 minutes before expiration. That's where all of the flow is going to come in. That's where people who have to hedge their potential payout on options or try and sell ahead of knowing that they're going to be able to exercise their options will do their business. This then leads to some quite direct moves for at least a very short period of time, typically with a significant amount of volume as well, and a very clear sort of action. We've seen it this year. The trade this year has been more so the NASDAQ than the S&P, but done in both, where people sell one or the other or both of them 5 minutes before the open, so 5 minutes before the option expiry. They will generally drop reasonably quick, and then at the open, they will probably reverse. It's a less clean trade because they don't necessarily reverse straight away. So for most people, the trade is sell it at 225, get out at 229.5, get out, take your trade, take your money. What a lot of people have been doing then is buying the Dow. So the Dow seems to be the one that rallies on the option, on the expiration. So a lot of it is less about necessarily the deep understanding of what's going on. It's about the pattern of the way it's working. For the first time in 6 months, that didn't work on Friday. So it'd be very interesting now, the November one, what it does. Do you then start seeing it go up beforehand as people realize they can't sell it because they get toasted on it? Do I trade the JP Organ? I'm assuming that's a misspell. I'm going to guess JP Morgan, but I'm not quite sure of precisely what the question is. I'll wait for the question to come in, Ian.
Organ futures market.
Don't know. There are futures on some individual stocks. They're pretty illiquid, but there are futures on some of the big stocks like Apple, Amazon, probably JP Morgan. There's certainly options on all of those as well. That's the most traded bit, the options on individual stocks. What you will also get is quite consistent broad patterns on option expiry. This is something we saw 2021, and we've seen it quite a bit this year because you're in this steady uptrending market, that the option expiry will create a sell-off and then rally. What you've got to do is try and work out how you trade this. This is really easy. That's a daily chart. Basically, option expiry, drop, buy it, up it goes. That's really easy, apart from when do you buy it? Everyone wants to buy the low. You've got no idea where the low is. So you buy thinking you've got the low and it goes another 50 ticks. Do you stay in and still believe the idea, or do you not? So it's really easy to sort of say, oh yeah, that's the way to do it. The pattern's there. You've then got to work out what part of the pattern is tradable. And that's essentially short-term trading. So what I've got then is this is on an hourly. This is a breakdown of option expiry week, the week after option expiry. So the idea being then, you've got the general idea that it's going to go down and then back up. You've then got to work out the sort of phases of the move and where you want to get involved. Starts to play out that generally what you get is not much, a sell-off and then a rollover. That looks easy. The hard bit of it is the move down was quite inconsistent as to whether it would do it all on the Friday and start to reverse, or whether it would do it Friday into Monday and reverse. So it's not an easy one to try and buy the low on Friday, because it may continue into Monday as it does in this instance here. So what I was more starting to look at was what happens after it. If you've seen the sell-off and it starts to bounce, now the trade's on. So the trade ends up being that what you get is after it bounces, you get this kind of little basing pattern. From that basing pattern, I'm then looking for the open on the Monday, and it can be on the Tuesday if it doesn't do the bounce and base pattern. Once it does that, you're trying to buy the open, and you're looking for this really, really fast explosive move off the open, which can then happen the day after as well. So whilst the idea is, oh, wait for it to drop, buy it and play it back, really the trade is wait for it to drop, wait for it to consolidate and play that move. And that's the bit that you're interested in, because that's the bit that happens consistently. I'm not interested in all of this, because that's, well, I don't want to say it turns into speculation, it is speculating, that's the whole job. But this is the bit where it's a harder trade to manage. Because if you buy it, let's say you buy it down here, at what point has this gone far enough for you to say, yeah, that's enough, I can get out? Equally, at what point are you wrong? Because if you look at the pattern, it always goes and breaks the record high afterwards, or was at the time. That doesn't give you any indication as to whether it happens the week after, 2 weeks after, 3 weeks after, and how low has it got to fall back before you can say, actually, it's not going to do it this time. Whereas if you can look at this and go, well, it's the Monday after option expiry, we put in a nice consolidation pattern, I can play the open, break out of that range, then you've got some clarity on what you're going to do. That will either work or it won't, but you have a clear expectation of what's going to happen. So this is then the trade on a 1 minute. I can give you various examples of this. When we get replay up for you guys, I can give you a sort of list of option expiry open breakout trades to go and have a look at that sort of explosive open trade. But the whole idea of it, this is the overnight. So this is that Monday where it trades down again and then bounces back. This is your little sort of basing pattern. Nice sideways consolidation going into the open. What I'm looking for then is to play the break of the overnight range. Get through there, you're looking for this real fast explosive move at the open. Soon as you see that and it starts to settle down, that's the trade done. So you effectively done sort of a week of structure to play about a 15-20 minute move. It doesn't mean you're doing nothing in the week before, but you know that when you've seen that pattern the week before, that trade is now on. And that's the way that you're trying to sort of think about it.
Do you need to see it sweep liquidity first before breakup, like it has in this example?
As in the move down and then back up?
Yeah, like it
that's ideal. Yeah, that's a really nice thing to see.
It takes liquidity out of the consolidation. And then
Yeah, it would be nice.
Yeah.
If you don't see it, I still wouldn't be put off from buying the break of the overnight high. That's just, it's one of those things where it's an added bonus because now your conviction goes up.
Yeah.
That absolutely, anyone who was buying it could well have got washed out and now they've got to come back, which will add to the pace. So yeah, useful but not prerequisite.
Okay.
Final one that I'll touch on was, this was something that someone on the course talked about a little while ago. And he was talking about the sort of concept of protection. He was an options dealer for a European bank. So he was talking about, he was saying the euro's a sell, just sell it, it's going down. So, well, why? And his view was, well, nobody's got any protection, i.e. in this move up here, the open interest of put options on the euro dollar had not increased, Therefore, people are buying and they don't have any protection on the downside. If price starts to fall, all they can do is exit their long positions because they don't have put options that are going to protect them. So his view is, well, it's going down. The problem with that is you can sell it up here on an hourly. At what point are you wrong? Because yes, nobody buys protection, but if the price keeps on going up, they don't need protection and they're fine. So it's a real difficult trade to know that you're right on. And this is, I think, the difference between someone more institutional who's kind of looked at this from a broad perspective versus a sort of more short time frame perspective of it. If you can see that there is no increase in put option open interest, yes, people aren't protected. So if it does start to fall, you can expect it to fall quite quickly. But if it doesn't start to fall, nothing's going to happen. So rather than just selling it up here with some kind of vague stop that could be up there, you're better off to kind of go, well, with that information, if it starts to break through these lows, then I want to sell this. So that's then taking out the bottom of this pennant. If it does that, absolutely sell it because you know no one's protected. But there's no point in selling it up here because it's a speculative, hopeful trade that your idea actually pays out, something actually turns into something. So it's a lot of short-term trading is about taking information and going, well, I could see what's going to happen if this starts to happen. And if it does start to happen, I'm all over it. If it doesn't, you don't need to do anything. So that's something else that people can start to look into. If you can see, you have to watch them quite a lot. You have to watch that change in open interest over time. But if you do start to see that on a directional move, then you have that vulnerability. It's probably something worth looking at in euro at the moment, whether there is a great deal of change in open interest of call options on the euro, because the euro has done this sort of very steady drift lower. I'll show you what I mean. There you go. It's done this kind of just drift over the last week. If there's not been a great deal of buying of call options here, the assumption is there's a lot of people who've been getting increasingly short and are all vulnerable to this turning back towards the upside. In which case, if it does, they could all be forced to get out and give you this very fast, large liquidation type move. Similar, you could look at gold and put options as well. Gold's done that very sort of straight line drift. So someone wants to go and have a little research, go and have a go. There might be a really nice trade in it. Right. Ian, on the do you trade the JP Morgan collar? No, on the basis that I don't know what it is. I could look up what a collar is and try and explain the strategy, not right now, but no one trades it. But I'm going to guess it's similar to some kind of straddle type idea that as long as the prices stay within a certain range, you're going to make money on your options on both sides. But no one actually trades it. I think anything that's got a name like a JP Morgan collar, it's probably for them to be doing and is probably a little bit too well known, yeah, and a bit too broad for us to want to be actually having a go at. But do let me know what it is, because it'd be quite interesting to actually have a go at it. That's wrapped up everyone on futures and options. So unless anyone's got a desire for any questions, throw them out there. Otherwise we can wrap it up there for today. Videos tomorrow will be up or are up already. So you do some of those tonight, tomorrow morning, whenever you want. As I say, for you guys, I'll be in tomorrow anyway. So we're going to discuss what's going on in markets, get everyone set up on sims so you can start clicking, which is useful. I am expecting somebody else to come and join you tomorrow as well. Don't know where they are, but we shall see. But for those of you online, I will see you tomorrow. Session will be at 2 o'clock tomorrow, so we won't have a morning session tomorrow. You've got the theory bits. We'll cover some of that in the afternoon if there's anything particularly pertinent to talk about. And then we'll also do setting up sims, what you need to understand with a ladder, what you want on some of your charts, etc., etc. I see Jacob's about to ask a question. Nope. Right, I will wrap it up there. Throw any questions in. If there's anything that really needs answering, I will either answer it in the group or I'll cover it tomorrow. I'll send over a couple of PDFs as well with contract symbols, contract sizes, and all of that information, session times, etc. Right, see you all tomorrow.